This is Sarah Cage, and I'm joined by my co-host, Adam Olsen. How are you doing, Adam?
Not too bad.
And we have Jason Larkin back in the building, no longer managing director, but Mr. President, the market president of Dallas. Jason, why would we invite you to come here and talk to us today about IPOs? Why did we pick you?
Yeah, so I think we got good feedback on the first couple of podcasts, so maybe that's why.
Yeah.
Fan favorite.
All of those were the most liked, yeah.
Yeah, so I think one of the areas that I've been really fortunate to get some experience in throughout my career is as companies are thinking about going public, IPO readiness assessments, and actually right now, from an Embark perspective, helping lead a couple of companies through the IPO process, traditional IPOs, and also in discussions with some companies in SPAC. So hopefully can share some of those real life experiences that we've been working through with those companies as they go through the IPO journey themselves.
That's awesome. And we've alluded to it, but today our topic is IPOs. And this is a topic that's really top of mind, whether it be through traditional IPO or other alternative vehicles like SPACs, which we actually have an episode on. We've seen an increase in all of this. And so we won't have time to hit on every potential issue that can be raised for companies exploring these opportunities, but we will highlight some of the top common accounting reporting concerns that companies may face. So keeping that in mind, these are areas where there might be increased judgment. Complex accounting is often included here as well, and areas where the SEC staff are known to raise comments during their review process. So I think this is going to be a really helpful conversation for our listeners. And without wasting any more time, let's jump in by, I guess we'll start with Jason. Let's kick it off with the first item on our list, which is segment reporting. We always give you segment reporting. I think Jason has talked about segment reporting on every single episode we've had him on.
You requested.
Yeah, I'm trying to keep consistency for the listeners.
Is that the only codification that you know? Okay.
Exactly. Yeah, that's right.
So segment reporting, what impact does going public have on an entity's need for segment reporting? Yeah,
so I think it makes sense to start here because this is one of the first areas as a company is considering going public that they really have to think about, because the segment reporting disclosures are not required for private companies. So under ASC 280, which is the segment reporting or the segment accounting guidance, there's not the same level of requirements, especially from a disclosure perspective for private companies. Private companies still may be familiar with some of the concepts around this because a lot of companies utilize it when they're looking at goodwill impairment analysis. They have to determine their reporting units for goodwill impairment analysis, but ultimately those operating segments, reportable segments, may not have given as much thought to that as a private company versus needing to really think about it and make those accounting determinations as a public company.
And maybe for those who haven't listened to our segment reporting episode or haven't seen you on another episode, we can just give a brief overview of what segment reporting actually is and what it's intended to achieve.
Yep. Yeah. So ultimately, segment reporting is really to provide the users of the financials with more information about the different types of activities and business environments that those companies operate in, and really give a lens for investors into understanding what the company's performance is, expected cash flows and operating results for the organization, and then just judgments that the company makes about the organization. I always think about this in the context of how does the CODM or the chief operating decision maker really view the business, and communicating that to the users of the financial statements in the context of how do they assess performance of the organization and then allocate resources.
And then just practically, how is segment reporting guidance applied?
Yep. So I think the first step is really to identify those operating segments, as I alluded to earlier. So figure out what are your operating segments. And there's some specific criteria that we outline and go into a little bit more detail in the other segment podcast, but identify those operating segments, then assess if you need to aggregate those for reportable segment purposes, which is what ultimately goes into your disclosures as a public company. Then determine if those reportable segments cover enough of the operations of the business. There's some specific criteria in terms of the total percentage of the business that's disclosed. So you have to double check that. And then there's some other potential disclosures that may be required that you have to go back and check to make sure that you've complied with all the disclosures.
So we've talked about segment reporting quite a few times. So it's obviously important and challenging. And so why is it so challenging and why is it at risk for SEC comments?
Yeah, I think it's one of those, you look at any of the reports out there on SEC comment letters, it's always there. And I think it's really being driven by the amount of judgment that's inherent in determining your segments. And one of the key red flags that often comes up, if you ultimately determine you have one reportable segment, that's a real red flag to the SEC to really understand, were there multiple operating segments that were identified that ultimately got aggregated? How did the company go through and determine that those had similar economic characteristics to aggregate? And so those are some of the things that they really focus on. The other key thing to think about is this is not just a disclosure for your financial statements, but ultimately it flows through into how you disclose things within MD&A and other components of the public filings that you're going to have. And so it has a pervasive impact. And one of the reasons why the SEC is so focused on making sure that companies have really properly applied the accounting literature.
All right. Well, we're done with segment reporting. So Jason, thank you for your time.
All right. See you guys next time we talk about segments.
Can we bring it up again?
I'm sure we can. We will. You guys will know so much about segment reporting by the time we're done with Jason.
Yeah, he's your guy to call for sure.
Well, another concept for private companies that might find themselves going public to consider is earnings per share guidance. This may or may not be a big deal depending on their underlying capital structure. But as we've seen, when capital structures are complex, maybe you have multiple classes of equity, it can be challenging to exercise. It can be challenging to undertake this exercise. So Adam, can you recap the basic requirements for earnings per share?
I'll try. I feel like this one can get a little hairy, but like you said, depending on your underlying equity structure, it may not be that big a deal, but oftentimes, there's a lot of complex equity instruments involved. So it tends to cause a little more panic than most would like. So ASC 260 is the guidance that provides kind of the framework for earnings per share. And basically high level for each of your periods that you present in your financial statements, you have to present both a basic earnings per share metric as well as a diluted earnings per share metric. And there's also some related disclosures, related to both of those as well.
So can you take a little bit of a deeper dive into the difference between basic versus diluted EPS?
Yeah, sure. So basic, it's formulaic. Like I said, it is a calculation. So you're basically looking at all the income that's available to common shareholders, and it's going to be divided by the weighted average number of common shares that you have outstanding. So on the other hand, diluted earnings per share is really determined by making adjustments to both your numerator and your denominator. And those adjustments are really to reflect income and the weighted average number of shares that would have existed had the potential common shares been outstanding as common shares during the entire period, or if they were issued during the period, from the date they were outstanding or potentially outstanding. One thing to keep in mind is that, from a diluted earnings per share perspective, potential common shares are not included if they would make the measurement, what is considered anti-dilutive. And that is basically when you include that, potential share into the calculation, it would increase your earnings per share. So has an anti-dilutive effect. So no need to include that if that's the outcome there. Like I said, there are a lot of complexities, related to earnings per share. If you've got multi-layered, equity structures, multiple classes of common shares, or you got participating securities, options, warrants, convertible instruments, preferred stock, all of those things can add a lot of complexity to the calculation. And, many times private companies do have a lot of those different type of equity instruments. So when they first take this exercise on, it really isn't as straightforward as they would like.
And what types of comments might the SEC raise here?
Yeah, so most of them really do just stem around the calculation of earnings per share and trying to understand maybe some of the determinations that were made, particularly if you do have a more complex equity structure. So if you're other parts of the financial statements or your registration statement, indicate multiple classes of, common shares, and you don't use this two-class approach that exists under the EPS guidance. There may be questions around how did you make that determination? There could be questions around just some of the disclosures that are involved there, adjustments that you made, things of that nature. So it really comes down to the complexity is where we see most of the comments raised by the SEC, just trying to understand, is the approach you took correct? And can you help us justify why that was the right answer?
All right, and we'll switch gears and we'll try giving Jason a non-segment reporting question, but we'll see how this goes.
This is my trial for the next podcast.
We'll see if you have credibility. Moving on, we're going to talk about non-GAAP measures. So I know this is something that companies may have to contemplate when they're looking to IPO. So what exactly are non-GAAP measures used for by companies?
Yep. Yeah. So I think I'll start by saying companies' financial statements have to be prepared in accordance with GAAP. So there are non-GAAP measures which companies can utilize to provide information that they think is valuable to investors. Financial statements have to be under US GAAP. Typically, these are numerical disclosures that provide additional information around financial performance, financial stability, liquidity, those types of things. Some of the common non-GAAP measures that we see are EBITDA, adjusted net income, those types of metrics which management believes is beneficial to the users of the financial statements. The real intent of these is to highlight some of the key information that's occurred throughout the reporting period as a company is going through their public filings.
So are there any guidelines companies have to be aware of around these non-GAAP measures?
Yep. Yeah. So there's a whole host of guidance within Regulation G and Regulation SK, Item 10E, that really require a framework of what's going to be disclosed in accordance with non-GAAP measures. This is an area where we've seen a pretty high level of scrutiny from the SEC recently. In the context of really a couple areas. One, is the information misleading to investors? Is it more prominent than the GAAP metrics? And then also just lack of labeling things as non-GAAP measures. Part of the guidance in the regulations require you to label these as non-GAAP measures. So that way the users of financials can understand these are truly non-GAAP measures that management believes is important and beneficial to the users.
And this one's just for free, but are non-GAAP measures typically driven by industry? Like, are there certain industries that maybe use certain metrics or?
Yeah, so I think there are some metrics that are used specific to certain industries. One example that comes to mind, same store sales from a retail perspective, just as one. I think EBITDA is one that's used a lot across a lot of industries, but there are some industries where if your peers are disclosing certain non-GAAP measures as a company who's thinking about going public, at least something to consider if those metrics are meaningful to you and important to the story that the investors are telling.
Yeah, you'll see it a lot in adjusted EBITDA where they're making adjustments to EBITDA on top of the EBITDA adjustments from net income. So, I think that's where you'll see a lot of comparable industry adjustments.
Yeah, I know I've seen adjusted EBITDA RE for real estate, and that one's just like, we really added more letters to EBITDA.
Adjustments on adjustments.
Adjusted. Okay, well, for this one, what does the SEC look for regarding non-GAAP measures?
Yeah, so I hit on one of them already, but I think the key things that we've seen in SEC comment letters are if you give more prominence to the non-GAAP measures than the GAAP measures. So practically, what does that look like? Placing the GAAP measures prior to the non-GAAP measures in the ordering of the document, and then making sure that you're reconciling the non-GAAP measures to the closest GAAP metric. Those often get comments if a company doesn't go through that from the disclosure perspective. The other one is if the disclosures or adjustments associated with those non-GAAP metrics are not clear or understood. As an example, when you're going through an adjusted EBITDA walk or reconciliation, making sure that you describe each of those adjustments that are not inherently clear based on the caption itself. I think the third is just the questions around each of those specific items that are included in that reconciliation of from GAAP to non-GAAP metrics, explaining why those are infrequent, unusual, and non-routine, because those are the types of adjustments that you would expect. And if there's questions as to why those meet that criteria, that's when the SEC often comments and asks for clarification.
Well, that leads us nicely into MD&A, which is another hurdle that private companies are faced with when going public. The intention here is to focus on their ability to communicate to investors and other users of the financial statements the relevant information they use in their decision making. Is there anything you want to add to that, Jason?
No, I think you hit a lot of the points right off the bat. I think the purpose of MD&A is to provide the readers with information around financial condition, changes in financial condition, liquidity, capital resources, and then the results of the operations, providing that incremental detail along with just the numerical information, some of the reason why, right? So that way the readers of financials have that incremental information. And Regulation SK does provide guidelines around what is required of management when you're going through and preparing MD&A. The other thing I would just say operationally as companies embark on the IPO journey is this is an area that does take a lot of time to really iron out how are we going to describe the changes in financial position and liquidity and those types of things. And so an area of a lot of focus as companies go through the IPO process.
Was that some intentional subliminal messaging with the Embark
It was.
on?
Yeah. I try and
like
that in where I can.
Yeah. Well, word on the street is that the SEC has issued some amendments fairly recently. Do any of these impact MD&A or risk factor requirements?
Yes. Yeah, they definitely do. I think part of the recent changes are to really help modernize the MD&A disclosures that we have and meet the current needs of investors, right? As we've evolved from an investor community, from users of financial statements, I think it's important that they are considering some of those guidance. I think part of those amendments was actual changes to item 303 within Regulation SK, which is really the focal point of the MD&A guidance that we have. And one of the things that they tried to do was reduce those disclosures that weren't beneficial to users. A specific example of that is the tabular disclosures around contractual obligations. That information is included elsewhere, and so there wasn't a need to replicate that within MD&A. So I think there was really a lot of thoughtfulness around these disclosures to try and narrow the focus and make it easier for users to read MD&A, because historically that has been a section of the document that can be very difficult to get through and very cumbersome and detailed.
And keeping with our pattern, what are some common things the SEC might bring up related to MD&A?
Yeah, some of the common things that we see as comment letters from the SEC is being vague with respect to the changes in the financial condition and making sure that you clarify what actually drove that change that's being talked about or disclosed. I think the other one is if there's significant variances that may have offsetting impacts and you're not disclosing from a gross perspective, what are the changes that may be offsetting to each other? That is something that we've seen comments on. And then the other one is just around future liquidity. This is something that's clearly important to users of the financial statements to understand that future liquidity. And part of the clarification that came out recently from the SEC is really focusing on those liquidity disclosures and making sure that the user can understand future liquidity requirements, plans, et cetera.
All right, we'll move into the next area. Another area that can cause complications is business combinations, another favorite topic around here.
Sure.
This one can be especially complicated when there's an acquisition. There might be subsequent financial statement filing requirements depending on the timing of that acquisition and when they file any registration statement with the SEC. So let's start from a US GAAP perspective. Are there any changes to the accounting for a business combination once a company decides to go public to keep in mind?
Yeah, there are. So there's a few things to really kind of keep in mind here. I think one of the biggest changes that companies will come across is just around some incremental disclosure requirements for their acquisitions under 805. So there is an additional disclosure requirement to include pro forma information under 805, which is only a public company requirement. So it will be one area that private companies will have to kind of incrementally true up that disclosure for. But I also want to highlight that there's another just pro forma disclosure requirement under Regulation SX. So Article 11 also has additional pro forma disclosure requirements. And I think a lot of times people assume that one will satisfy the other. And while they do align on certain things, there are some differences there. So it's not enough to assume that because you've met the incremental, US GAAP disclosures under 805, that you're automatically going to satisfy all the requirements under Regulation SX. So just another thing to keep in mind as you're kind of looking at your disclosures and figuring out where additional pro forma information is going to be necessary. It's not just within the statements themselves, but also within the registration statement.
Adam, one question I've seen come up is if there's any elections that companies have made as private companies that they need to consider when they're thinking about going public.
Yeah, so this is obviously can be very problematic, and it's often something we as accounting advisors always try to warn clients when they're thinking about like a public exit strategy, IPO, SPAC, or something where they historically are either have taken a position to take a private company alternative, or maybe they're exploring it currently because it does make the accounting easier in a lot of situations. Obviously, if you are kind of moving down the public space, any of those alternatives within GAAP that were permissible for private companies are not allowed. So there are a couple that do come into play around business combinations or would be associated with business combinations. So if you took the alternative to amortize goodwill that was created through a business combination, obviously you would have to unwind that accounting, that amortization. You'd have to go back and historically reperform impairment tests. There's also an alternative where people could have subsumed certain intangible assets that would have been identified in a business combination, and instead those get subsumed into goodwill and amortized. Those would have to actually be pulled out and separately recognized. So couple things there, but there's other alternatives outside business combinations. So just in general, it's always a company should have a good inventory of what their accounting policies are, and if there are going to be problematic existing policies, thinking about the efforts to unwind those and adopt transition them to what would be required of a public company. And I guess one more thing I might just highlight around business combinations is just kind of the definition of a business itself. So obviously US GAAP provides a framework for determining whether a transaction is a business. One thing to keep in mind is the way the SEC defines a business is actually different. So that being said, there could actually be transactions that are not a business under US GAAP that potentially the SEC could deem as a business. And this is important when you're just trying to think about whether there's been any significant, acquired businesses that may require incremental financial statements or things to be included in the filing. And that's because the SEC really kind of, takes the standpoint of a business from the perspective of just whether or not an entity has like continuity of revenues versus kind of the screen test inputs, outputs, processes kind of assessment that you go through under US GAAP.
And what about from an SEC reporting perspective? When might a company have to think about other financial statements of its acquired businesses?
Yeah, so kind of just, what I was alluding to here with you, when you're thinking about definition of a business, acquired businesses, things like that. But, a company really has got to have a good inventory of what were all their significant acquisitions, especially made around the timing of the filing of their S1, and really thinking about, depending on the timing of those, the significance of them. They could be required to also submit separate financial statements, anywhere from 1 to 2 years, including pro forma information. And that's required under Rule 305. And that's, generally one area that, depending on whether or not those entities had historical financial statements or audits or things of that nature, can be quite a big exercise and pretty daunting. So just something to, stay close to for sure.
Yeah. And I think in those cases, sometimes I've seen you end up involving additional external auditors. So you have your own external auditors for your financials, but then you have significant acquisition. There's another set of auditors that are now involved. And so, more auditors equals more fun for everybody, right?
A lot of parties.
Oh, well, how is significance determined for these transactions?
Yeah, so there's essentially three tests that you perform, and you basically take the highest outcome of the three tests to measure your significance. We could do an entire podcast on all those tests if we really wanted to, because they can get pretty complex in applying them. But just high level, the three tests: there's an investment test, there's an asset test, and there's essentially an income test that has to be performed. And you would do that for all of your, recently acquired businesses or potentially probable businesses that could be acquired as well that might be on the pipeline.
And to round us out on this part, what are some common SEC comments that might be raised here?
Yeah, a lot of it comes down to disclosure. Again, just not providing enough good information to users of the financial statements. So asking people either expand on their disclosures if they feel like they're too light or they're missing critical elements, or if there's information that's deemed material that was excluded, having to add stuff around that. And to the extent maybe a company is taking the position that something was not material, that's why it was excluded, or pro formas weren't included for this reason or another, the SEC is going to want to understand how that rationale and conclusion were made.
All right, and moving on to our next section would be stock-based compensation and cheap stock, which, to start us off with, maybe Adam, can you give us a definition of what cheap stock is?
Yeah, so cheap stock is essentially, stock that was recently issued prior to the IPO that essentially is viewed as having a value that's significantly below what the expected IPO price would be. And so the SEC will often focus on cheap stock, as companies are preparing for their IPO or SPACs or whatever the case may be, really just to try to understand what was the rationale for any kind of fair value measurement differences between, underlying stock that was issued. So if you think about employee stock options or things of that nature, and what the anticipated IPO price is. Oftentimes when there's something there that looks kind of questionable to the SEC, they're going to ask a company to help reconcile those valuation differences and explain to them, why this stock price when this issuance was made is varying so much from what your anticipated IPO price would be, and a company really has to try to justify that rationale of why both measurements are reasonable, and the failure to do that results in what's often referred to as like a cheap stock charge, which basically requires oftentimes a company to recognize additional compensation expense or some type of other expense related to the issuance of those equity instruments. And in many cases, when that charge happens, it does end up being a pretty material number. If you think about in the case of like stock options that could be given as an incentive plan to tons of employees or C-suite or non-employees or whoever, and you're having to make an additional comp charge, it can potentially lead to restatements of prior financial statements and things like that. So it is a hot button issue with the SEC. So I think it's something companies for sure need to kind of stay close to and understand that, hey, is our valuation team doing what they need to do? Do we understand the inputs, judgments that are being made, and can we support them?
Yeah, that word restatements makes me get a little sweaty. Well, as they're evaluating these cheap stock issues, how far back does the SEC typically look?
Yeah, so the SEC will say they're focusing on recently issued shares or options when they're kind of doing this evaluation, but recent to the SEC can be anywhere from even 1 to 2 years from the anticipated, IPO date or the effective date of the registration statement. So, it's not going to be like, things that happened in the last 6 months. They're going to actually go back quite a bit and do some digging. So when you're really thinking about prior evaluations, issuances, I guess the timeline is much broader than I think a lot of people expect.
And what questions would the SEC raise around this issue?
Yeah, so most of them are going to be around just the valuation premise. It is a valuation exercise. So it's just trying to understand assumptions, methodologies that were used to value the stock, thinking about the staleness potentially of some valuations that private companies may be using to justify why they, use a certain price, because private companies historically, they don't get recurring valuations. They may do an annual valuation, semi-annual, who knows? They're typically not, doing a valuation at every grant date. And so just trying to support, that those one time a year valuations rather are are reasonable is another area they'll ask about. Discounts on the valuation. So just thinking about like, when the company is private, there's lack of marketability of those equity instruments. And so just understanding any discounts attributed for that lack of marketability. I think if you talk to a lot of accounting advisors, they'll reference to the AICPA valuation guide, which is really used as a good tool for companies when they're working with their valuation teams, valuation specialists to make sure that they're doing the proper due diligence, that they can support their key assumptions, methodologies. And it has a lot of good pointers and stuff, particularly around pre-IPO, post-IPO valuation. So it's definitely a resource we recommend people be familiar with.
All right. And throughout the episode, we've kind of layered in these questions about SEC issues that they commonly raise. And so that typically happens in the comment letter process. So could you talk a little bit about what the SEC comment letter process looks like? We are assuming that everyone did everything perfectly. They've listened to our advice, but you still get an SEC comment letter.
Yeah,
so
it's kind of like turning in your homework and waiting for it to be graded. So essentially, like, the company goes through all the hoops and everything they got to do to get their registration statement ready to go. Once that registration statement is filed with the SEC, it generally has up to 30 days to perform its initial review. It'll provide its comments to the company on that registration statement. The review is going to be done by somebody at the SEC staff who's going to obviously read through the entire document, really try to familiarize themselves with the company, the business, what they do. They'll look at other information related to the company. So press releases, they'll go to the company's website, they'll look at news articles around the company just to really get familiar with who they are, their industry, their competitors, the management team, all of those important factors. But the review itself is obviously going to be focusing on like the financial statements and other financial data that's included in the registration statement. They'll look at the auditor's report as well. And really just to make sure that all that information complies with all the various regulations and guidance that's out there. So both SEC regulations, authoritative accounting guidance from US GAAP, SEC staff policies, interpretations, things of that nature, that they're all, aligned or materially aligned with those different frameworks. So it's important that the company obviously stay connected with the staff as they're performing their review. Obviously the staff is likely to issue comments, through the form of a comment letter that's going to require follow-up responses from the company. And, when the company receives those, comments, it's obviously going to, probably rope in other parties from their end as well. So thinking about, their legal counsel, they may have accounting advisors that they're working with, their auditors, obviously the management team, all of those people are really going to have to come together to, make sure we understand the scope of the comments, the intent of the comments, and really, work on a path forward to address those comments. All of the comments obviously have to be addressed and resolved before the staff is going to deem that the registration statement's effective. And, we also, tend to warn people that it's not like it's a one and done set of comments. Obviously the effort and you put into your response to the SEC's comments, may or may not warrant follow-up comments. So just kind of something else to keep in mind is that there could be additional, sets of comments coming your way. So something else to be aware of, especially if timing of the IPO is of obviously important and things of that nature, that the review process could potentially hold stuff up like that. Obviously, if there's any changes needed, they'll amend whatever needs to be amended in the registration statement. So whether it's, how they accounted for things, oftentimes it's mostly disclosures and cleaning up language and things of that nature. They'll do that and, resolve those comments with the staff. The SEC will eventually deem the filing effective, in which case they will then be obviously allowed to go offer their securities publicly. One thing to keep in mind as well is that SEC staff's comments become public. It's at least 20 days after either the review is completed or the registration statement is deemed effective, but they do become public domain. So everyone can go out there and see the SEC's comments and your responses as well.
So that sounds like some pretty high stakes. And I don't know if you're like me, but I usually have like a final V4 saved to my desktop. And so Is there
just V4?
Yeah, it's like final for real this time.
Yeah.
Yeah. So I'd love to get things reviewed. Is there a draft process where maybe you could submit a draft before it has to be finalized?
Yeah, there is. So I'm glad you mentioned, companies that are obviously going through the traditional IPO route, they do have the option to submit a draft registration statement. I don't know if Jason, you saw this in some of the deals you've been working through, but it is pretty common to do. And the SEC will perform what is known as a confidential review. So they'll basically review the registration statement. Obviously confidential. It allows companies to keep some of the information that would be available out there to the public under wraps for a period of time, so that their competitors or whoever else can't really kind of see into the company before they're ready to do that. But one thing to keep in mind is that confidential submissions eventually are going to be filed publicly. Mm-hmm. So if you've got a planned roadshow coming up, or you don't plan to do a roadshow, but you're going to request for it to become effective, then you basically have, I think it's 15 days or so is like kind of the timeline there that it'll essentially become a public filing for anyone to see. Yeah,
the other thing I would just say in that same regard, you mentioned staying connected with the SEC is around pre-clearing things with the SEC if there are significant accounting judgments that may warrant that pre-clearance process. So another avenue for companies to think about as they're going through, is there something that's highly judgmental where a pre-clearance letter or discussion would be beneficial?
Sure.
All right. Well, if we get through this whole process, what are some best practices you both can offer up when responding to SEC comments?
Yeah, I think one goes in tandem with kind of what Jason just said here about pre-clearance. Like, don't be afraid to reach out to the staff. And it can even be obviously before the comments come, but even when the comments are there, if you need clarity on a comment, you don't understand what's being asked, the intent of it, you're trying to figure out the objective, make sure you reach out and have a discussion with them, because making an assumption and then trying to respond, and then it's not even in line with what they're thinking, is where you end up with multiple rounds of comments and it delays the offering. Another is, don't just assume you can go search other people's comment letters and copy the same responses. I think it may be helpful to do a little research to see how others potentially handled similar comments or situations, but facts and circumstances always differ. It's hard to decipher if your fact pattern truly aligns with the companies that you're potentially looking at as an example, or what their materiality levels may even be. So what's material to you or them could be different. So it's always helpful to benchmark, I think, some of those things, but it shouldn't be assumed because they were able to get over the hurdle of a comment that you providing the same response will always, resolve it from your side as well. Yeah. A couple others is just, understanding the objective of the comment. Again, it's just, what was the intent? What are we trying to accomplish here? And then, lastly, I'll say a lot of times most comments are really, the resolution is more disclosure or just more transparency. So if there is a need to provide additional disclosure, whether it's in the current filing or they want you to include it in future filings, it may be helpful to give them a draft of the disclosure you intend to include, and then make sure that you guys are aligned on that disclosure so there's no further questions down the road.
Yeah, the only other thing I would add, I think those are all great points, is not being afraid to clarify within the response, right? If you feel the disclosures are in line with the requirements, but maybe within your response letter, clarifying as a company why we believe we're in compliance, and having some of that additional color and commentary, leaving that out of the actual document itself, but including it in your written response to the comments is something I've seen a lot.
Yeah, you'll definitely want to include references to US GAAP or, SEC regulations or things of that nature if they support your accounting position or presentation of certain items as well.
Yep.
All right. Well, thank you guys. I think that's plenty for us to cover today. We talked about a lot of topics from a very high level. Obviously, we could go deeper on a lot of these things. And in fact, we have on segment reporting for sure. We have other episodes.
For sure.
Just look for Jason Larkin's name. You'll probably find it. And we do have additional resources, and we'll try and link those in the show notes for you. But thank you both, Adam and Jason, for joining me today in this discussion. And thank you to all of our listeners for tuning in. We hope you found this discussion helpful, and we look forward to having you join us again on another episode of Accounting Matters.